Setting up a business is like a mountain to climb, wherein an entrepreneur has to face several challenges. Even if one manages to incorporate a company, it is just a tip of the iceberg. The most common issue while running either a startup or a large organization is insufficient finance. So there are different sources of finance, and borrowing is one of the most common ways of availing the needful funds. So there are again many different ways to borrow money, among which debentures and bonds are the prominent ones. Dear learners, this is Shashi Ramachandran. This video will introduce you to the concept of debentures and its types. Let's understand the meaning of debentures. So debentures are the medium to long-term debt instrument which helps companies to borrow money from the public. And these debentures are issued by the company uh, to raise the funds from the public. So debenture issued by a company is an acknowledgement that the company has borrowed an amount of money from the public which it promises to repay at a future date. So we can say that debentures are the creditors of the company. So as per section 2 subsection 30 of the Companies Act 2013, debentures are debenture stock, bonds or any other instruments of the company evidencing a debt, whether constituting a charge on the assets of the company or not. Now coming to the merits and demerits of the debentures. So investors who want fixed income at a lesser risk prefer debentures because it's a safe investment and they earn a regular and fixed interest on their investment. And financing through debentures does not dilute the control of equity shareholders on management. So debenture holders are treated as a creditor, they are the outsiders, so they do not have that ownership right. So they do not interfere in the any part of the management. And these debentures are less costly as the interest payment on debentures is tax deductible. That means debenture interest is a charge. So interest on debenture reduces the profits of the company and that leads to reduction of the taxes on the profits. So it makes it less costlier than any other source of finance. The company, since these debentures, they do not carry any ownership right or voting right, that means the company does not involve its profits in a debenture. So debenture holders, they do not have any rights on the profits of the company. And the issue of debenture is appropriate in the situation when the sales and the earnings are relatively stable. That means the company, if they have a regular inflow of cash, if they have a good sales and the earnings, then they can of course afford to have these debentures. And since they are attached with some fixed commitments, that is interest to be paid off, the principal amount has to be paid off after a certain period. So a company which have a stable sales and earnings, for them debenture is a best source. Beside the merit, there are some drawbacks also of these debenture. As a source of finance, we can say each company has certain borrowing capacity. So with the issue of debenture, the capacity of the company to further borrow funds reduces because they can extend their borrowings to some, they can like expand it to some extent only. So when they raise funds through debentures, their capacity decreases. And moreover, no flexibility to making payments to debenture holders because it involves a fixed commitments to pay interest regularly and the obligation to pay the amount when it is due on the part of the company. So debentures put a permanent burden on the earning of a company. Therefore there is a greater risk when the earnings of the company fluctuates. So if the earnings are not stable, it is that's fluctuates, then it's a really source where you can say they cannot fulfill the commitments to pay interest regularly or to repay the money. Then these debentures are also secured by any of the asset of the company. So in that case, the business may not have a freedom to sell certain assets. Now moving ahead with the types of debentures. So from the point of view of security, redemption, conversion, record, rate, the debentures are classified as shown on the slide. Now the first one, that is from the point of view of security, debentures are of two types, that is secured debentures and unsecured debentures. So when it comes to the aspect of security, a secured debenture is backed by collateral that is presented to the investors at the time of issuing the debentures. For example, when a company issues a secured debentures, it provides its assets or a definite span of property in case it fails to repay the borrowed money to the investors. So here the charge is created on the assets while issuing the debentures. On the other hand, unsecured debentures do not present collateral that can assure the investor that their money will be repaid or reimbursed when the time comes. So unsecured debentures are also termed as perpetual debentures. Redemption. From the point of view of redemption, there are again two types, redeemable debentures and irredeemable debentures. Now, redeemable debenture, based on the time period of a debenture, a redeemable debentures carries at an end date on which the investor can redeem the money invested in the debentures. For example, redeemable debenture that has a maturity date of 5 years will release the principal amount along with the rate of interest accumulated on the amount at the end of 5 years from the date of issue. That means if the debentures are for 5 years, redemption will take, the repayment will be done after 5 years. But based on the tenure of a debenture, irredeemable debentures is a debenture that carries no date of maturity and can be only redeemed when a company or the organization existence comes to an end. Means at the time of liquidation of a company, these irredeemable debentures are paid off. So one more important thing to remember, redeemable debenture for a stipulated period, irredeemable, there is no fixed period. From the point of view of conversion, there are two, convertible debentures and non-convertible debentures. So as the name says, convertible. So these debentures are converted into equity shares or new debentures of the company on a future date. That means the company gives an option to the convertible debentures that they can get their debentures converted into equity. Now, debenture holders have an option to exercise, like they have a choice to exercise this option whether they want to convert their debentures into equity or new debentures or not. Now, if we say that what's the benefit to the company here, like debenture as with any fixed income instrument, whether it is a bond or a loan, the debt it represents ultimately needs to be repaid. So too much debt on a company's balance sheet can lead to high debt servicing cost. That includes interest payment. So it's a fixed commitment which company cannot get escaped of. So as a result, companies with the debt can have a unstable earnings. Now equity on the other hand does not require repayment, nor does it require a payment of interest to the holders. So however, company might pay dividends to the shareholder, again a voluntary thing. From the point of view of the investors or the debenture holders, these investors they gain the benefit of fixed interest payments while also having the option to convert the loan to equity if the company performs well in the future. So you can say they participate in the growth of the company. So they, one way as a debenture, they have an option to get a fixed rate of interest. On the other way, they also have an option that if company is growing there's a growth in the company, then they can get it converted into equity and be the part of the company. So convertible debentures are a hybrid product that try to strike a balance between debt and equity. So investors receive a lower interest rate compared to the traditional bonds. So this is also one important thing to remember, that convertible debenture rate of interest is lower. Non-convertible, of course, is a regular debentures where which cannot be converted into equity shares. Moving to the next category, that is on the basis of record. So here there are registered debentures and bearer debentures. So again, registered debentures, these are the one which are recorded in the company's debenture holders register with the full details of every debenture holder of the company. So debentures are registered debentures are not negotiable. So negotiable means these cannot be transferable by mere delivery. Like simply you can't pass it on or transfer to another person, because these are registered. All the details are there in the register of debenture holder in the company. So there is a proper process to be followed to transfer these type of debentures, because the changes, the alterations are required in the register of the company. So then there is like a bearer debentures. These are not recorded in the company's debenture holders register. So bearer debentures are negotiable. They can be transferred by mere delivery, and registration of transfer is not necessary. Now here comes the point, that how they get their interest. So interest, they actually are issued with the coupon, and they have to present their coupon to collect the interest on the debentures. For registered debentures, all the details are there with the company, so they get their dividend like through bank or through other source, so because all the details are there with the company. Coming to the last category, that is specific and zero coupon. Now I'll start with zero coupon first. That zero coupon debentures, they do not carry any coupon rate, or we can say there is no interest on these debentures. So debenture holder will not get any interest on these type of debentures. So no need to get surprised. See, for compensating against no interest, companies issue these debentures at a discounted price, which is less compared to the face value of it. That means if in case the face value of the debenture, say it is rupees 100, is a face value, or I'll take 1,000 is a face value, then these debentures are issued at a lesser price. So the issue price is less than the face value, and the difference of the two is a one called as a interest earned on zero coupon bond. So the implicit interest, this is what, or the benefit is the difference between the issue price and the face value of the debentures. So these debentures are to be redeemed at a face value. Remember, these are issued at 950, but the redemption price, repayment price will be 1,000 rupees. So this will be the repayment or the redemption price. So that is the benefit what they get. So these debentures are to be redeemed at face value, and these are also called as a deep discount bonds. These are also called deep discount bonds. So all other debentures with a specified rate of interest are specific rate debentures. So specific coupon are the normal debentures with a specific rate of interest. Zero coupon with no interest, the interest only lies between as a difference between issue price and the face value. Specific coupon, the one which are the normal debentures with a specific rate of interest. Let's recap. I hope you like this video, share this video with your friends and do subscribe to my channel Exuberant Learners. Also click the bell icon to get the latest update on my channel. Thank you so much.